Keeping and retaining your best employees are important and very challenging at the moment. This video explores a few options that could be considered.
We are looking at ways to reward and provide benefits to our employees. Could you recommend some options?
There's a number of options that you can use to motivate your staff. I would look to normally motivate employees or even retain them or attract new key employees a couple of ways. So I'd recommend development of a salary packaging policy and also development of an employee share scheme plan.
How does salary packaging work and how does it add value?
Salary packaging can add value by providing benefits to the employee by way of pre-tax salary. This is where the employee can pay for their benefits through the employer. They receive less income after tax, but they also pay less tax to the ATO, therefore effectively increasing the employee's disposable income. Now, this can be packaging of a number of different items. So, for example, what I would recommend is probably a car, superannuation, a phone, or a laptop. But beware, salary packaging must be arranged prior to getting paid, as the employee cannot package salary after they have actually earned it.
What is an employee share scheme plan and how will it assist my business?
An employee share scheme, or ESS, is an amazing tool for motivating employees, boosting productivity, and helping retain high caliber talent. Employee benefits too, with the financial incentives tied to improving the business. Now, there are some basics that are required. So the employee acquires the ESS interest at a discount. Now, an ESS interest for tax purposes is either a share or an option in that company. It also means that when you're providing this a discount, so it could well be that they get them for no consideration or a reduced rate, that discount is included in the employee's assessable income. Now, once that's done, a taxing point occurs. Now, for ESS purposes, this point can either be at the time you've granted that ESS interest, whether it's the share or the option, or at some point later. Now, these are defined as upfront or deferred tax schemes, respectively. Now, again, be aware here that it's not a choice of when you get taxed. The plan structure determines the taxing point of the ESS interest. Therefore, that means you need to make sure you structure the plan before you issue any of the ESS interests. Also, this all needs to be in relation to ordinary shares, whether it's the share or the option relating to the share that's going to be provided. There's some concessions that are available, so there can be a $1,000 reduction depending on how you structure it. There are some startup concessions, so whether the company's been going for less than 10 years, less than 50 million turnover, there's some really good concessions, and we can talk about those if that's applicable. There's also availability to salary sacrifice up to $5,000 worth of shares to the employee. Now, also, we need to realise that ESS rules, they are taxed under ordinary income, which means there are reporting requirements to the company. Once there's been a taxing point, the company needs to report to the ATO and to the employee the amount that's in the assessable discount. Once there's been a taxing point under the ESS rules, CGT will apply to the employee, which effectively is when they dispose of or sell that share.
Employee share schemes and salary packaging may help with encouraging and retaining staff. However, both are complex with potential unintended consequences. Professional advice is recommended before you enter into these arrangements.